7th of September 2017 Sunday, and I'm recording based on what the markets have done for most of this month, and what the picture is likely to be. And the Nifty essentially closed down for this week after being up for 3 weeks. But when we look at it, essentially you had the big sell-off right at the start of August, when you saw the Nifty from its all-time high of 10,140 dropped to around 9685, and then we've been retracing and pulled back 66% of those losses, and but stayed within that retracement range. And moving a little lower this week, the strength was essentially in the mid and small cap indices, all of which have essentially ended up making what would be, or what at least looks like, a 3 to 4 month distribution pattern. As long as these indices stay where they are, that is within the broad trading range that they've been in. So if you simply just connect all the highs and lows of the mid cap or small cap indices for this entire period, it forms a broad expanding range. So you take the May high, you take the August high, and you take the high that was made just on Friday. They all have a perfect, they have perfect touch points, and so if you don't go significantly beyond that, or roll over from there, then I think a very broad distribution pattern would essentially be complete, and you would be looking at a lot of downside. So my sense is that you've seen underperformance in the mid cap and small cap indices all the way into early August, and some of that underperformance has actually come back in the last 2 to 3 weeks, where the Nifty is only retraced its losses, but these indices have actually done better after this gap, and this has led to what we call an intermarket divergence, when the key indices are actually lagging behind, and the others are actually making new all-time records. You can actually get even the reverse, but any form of intermarket divergence where new highs in one set of indices not confirmed by the others is a classic Dow theory signal that you watch out for, and it's usually an early indication of a potential market reversal. So I think you have that kind of a setup, and with Nifty remaining within 66% retracement, the risk reward essentially remains to the downside unless those levels are really broken past. And my sense is it probably won't be, because most of the nature of the rise that we've seen over the last 3 weeks has been corrective in nature. A lot of overlapping legs, series of 33333. It looked almost complete, or maybe one push was pending, I thought, this week up to 10,000, but that didn't happen. And since it didn't, and we've spent enough time here, I am really not sure whether you'll get that last spike up anymore. The other one is, a lot of people asking me the question, aren't we really heading to 10,500? And then somehow I discussed last time that number was one that I only spent a moment on at the start of January, because if you look at the entire move that happened in 2016, and then the correction in the last quarter of 2016, and you add that entire size of that move to the bottom post demonetization, you can get a C equal to A kind of equality of that size. If you get a sizable move, it would point to 10,600, but then that level is not sacrosanct, and of course that would be on a logarithmic scale. But that equality has almost been reached if you use an arithmetic scale. Now I'm talking a little very technical for those who are not used to it, but essentially a scale is, whether when you plot prices on a chart, are you looking at 10, 20, 30, 40, or are you looking at it in percentile, which means every size of a move is equal on any part of the chart and is the same percentage. Any charting software that you might be using would give you the option to switch between arithmetic and logarithmic scales, and when you're doing very long-term analysis, you essentially should prefer logarithmic scales, and most Elliott wave analysis is done longer term on that. In the shorter term, it does not matter. Also, at times it is worth switching between logarithmic and arithmetic scales and looking at both. Sometimes trend channels fit better on one, and sometimes they fit better on the other. So if you get a good fit on arithmetic scales, then more essentially, and especially on a longer term chart, it might be a corrective structure. But so we've seen very good fitment for arithmetic scales on, say, the Dow and S&P over the last several years, and for this entire move up since the 2016 low, I'm actually looking at the arithmetic scale on the Nifty itself. Initially I wasn't, but it looks like it's getting perfect fit there. Some people even use it for the entire period from, just like the Dow and S&P from 2009 onwards, and you're actually seeing a good channel rise, and that's also another reason why they're looking at, say, 10,700. If you draw an arithmetic channel from 2009, the touch points from 2010 to 2015 stretch all the way to a slightly higher level. But my point here is that it's not necessary that you really need to go to those extreme highs. Once you've seen the momentum roll over, and we're actually seeing a lot of negative divergences in momentum, similar to we saw in 2015, at least 5 6 divergences. This time we've got at least 3 now so far. Then at any point of time you can get a trend reversal. Of course, you need to see an actual price break to confirm it, and then we try to look at the Elliott wave structure to look at whether you're getting an endpoint. And I think this expanding pattern that we are seeing in the mid caps, the underperformance of the mid and small caps over the last 3 to 4 months, is essentially a sign of distribution and this intermarket divergence, where now Nifty is only retraced 66%, whereas all the mid and small cap indices at a 52-week high as of Friday yesterday, day before yesterday, is something that you should watch out for the week ahead. So that's as far as the market is concerned. This trend reversal to me would be more important than what most are thinking, because I've discussed this in the last video. Most people are looking at it as an impulse rise. They're saying it'll probably be a fourth wave, if at all, which means it will not overlap with the previous leg, still continue higher. And I've been looking at this more as a corrective structure as part of a long-term expanded flat, and any completion would be a longer-term reversal as well. So we'll see how that plays out. Of course, each move has leg to leg, and there'll be various stages in which people start to agree or disagree on something. Right now, at least, I see an increasing number of people agreeing on the potential for a correction, but the key question being asked is, will you really go to 10,500, 700 first? And according to me, it's really not necessary. But it is a mathematical calculation that gives you that number that people are talking about. Now the other thing where I find more and more agreement is on my long-term economic theory, something that I spent years discussing, and is part of my quantitative winter theory that I published years ago. And I've said this before, that since 2010 that I started writing it. Increasingly, I think after 2015, I'm finding people in agreement with at least the economic weakness that I wrote about. In fact, a lot of the issues which were related to debt, NPAs, have not only come to the forefront but been accepted by the markets, the RBI itself having pushed banks to really recognize and publish that data. So now everyone agrees that yes, we do have a problem related to debt, and most of it on the corporate side, which was very, very obvious in macro data if you simply looked at how the debt to GDP was panning out over the last 6 to 7 years, where while government debt was actually coming down, corporate debt was consistently going up, and that shift in debt was making the corporate risk sector increasingly at risk in terms of having a high debt, and therefore that meant that growth would really become an issue. And if you look at earnings for the last now 3 to 4 years, earnings growth has simply collapsed after that initial pickup that you saw in somewhere in 2014. And the markets are on a high essentially because of liquidity. But really earnings growth has been missing. Every year analysts have forecast that it would pick up in the second half of the year, and then the numbers still fell further. You ended up having 2 negative years in between. And again this year, if it was not for demonetization and for GST, I think most people would be projecting super growth for the year ahead. Now most of them are saying that it will pick up in the second half, but now I found in the last month or two a couple of research groups coming out and saying that probably it will take longer than that. Not everyone saying it, but a couple of them are beginning to say that, especially among foreign brokers. And they also gone to the extent of saying in the video that I sent out on the newsletter yesterday, Credit Suisse saying that even the 2019 numbers may have to be pulled down a bit by analysts who have been over expecting on the earnings pickup cycle. So that's how complex the situation is, but people are coming to terms with the idea that you just can't get growth when you are an overextended balance sheet. So that's tricky. So I have a reverse question, because I've been listening to a lot of presentations over the last 2 weeks at various conferences, from the economic side and investment side, the concerns that people are making. So which aligns a lot of them with the concerns that I would probably highlight. And what I mean to say is that people are accepting concerns, but I think under appreciating the potential downside effects of these concerns in terms of what plays out and how it happens. So here's a case. For example, most believe that the negative effects of growth would probably play out by the end of maybe by December end, and even if they go on longer, at least liquidity based reasons would provide reasons to buy dips, and things would get discounted quickly. Now, uh, a lot of the reasoning also for the current weakness that we are seeing in this quarter, or probably will see into the September quarter results, is being put on essentially demonetization and GST. And I have a reverse question: what if you didn't have demonetization and you didn't have GST? Then would have the GDP numbers, which have just come in at 5.7%, for the last month, the data that was just released 1.5 week ago, would these numbers have been at 9%? And I think the answer to that would be no. Really putting the entire blame on of growth on these two data points, I think is a little unfair. Would you be a rapidly growing economy if that was not the case? And the debate, of course, on how these GDP numbers break away from what you see in terms of industrial production has been going on and on. I've mentioned it a couple of times, and I think people are coming to terms with the idea how essentially the GDP GVA based new methodology works, where you're actually the value added. A lot of it is based on labor additions that you're doing, which when you're trying to actually do value add, you're trying to exclude certain data. So it's essentially the price change that is taking place between one part of the production cycle, or should I say the processes to the next one. And in between that, my sense is it's essentially a change in prices, and which change in prices should you accept as part of GDP or not. So I think indirectly or directly you end up including some of inflation into the whole process, which means that with all these new number crunching methodologies, new method of calculating CPI, new method of GDP, shift of focus from WPI to CPI, has essentially meant that when you're looking at GDP, you've actually transferred some of the inflation from inflation numbers to actually how you to part of the real GDP. So which is why you've also seen for the first time ever, sometime it was last year, you actually saw the reverse between nominal and real GDP numbers. Usually you'd see that nominal GDP is much higher, but you actually saw that gap narrow down and reverse for a moment, which was very, very unusual. And essentially, I think it has to do with how these calculations are done. So, I think that issue remains. You at the ground level, when you see there is no growth, there are of course couple of sectors doing well. There's that 20% of stocks out of the index which are still showing some kind of earnings growth, which is driving all the capital, whatever excess liquidity is coming in, is driving up valuations in those couple of sectors. But at a macro level, the economy is really at stall speed. So that's the clarity I think that most people are coming to accept. The other risks that they are seeing in the coming months are essentially those that come from the Fed itself announcing its balance sheet unwind. For example, one that would actually affect the bond markets most clearly. The other thing that you read a lot in the news is, of course, related to North Korea, and it's really hard to, discount what that means, because North Korea has been an issue for several decades. It's not something that I can put clarity to in terms of its what is really going on there, because many times rhetoric comes and then it disappears. Not just now, but if you go back decades, there's been a lot of statements made in the past and then nothing really happened. So how to really go by what was mentioned a month back? It did at that point of time get us all to look at those events much more closely, and it was a risk for a while. But it seems to be cooling off, and then your attention comes right back to what is happening at the economic level, and that really has not changed. So if you just remove even the geopolitical risk from the markets, then you start really looking at what is happening at the real level, and has that changed, and is there enough reason for the markets to go up apart from the liquidity reason. So uh, the big risk, like I said, it would be from the balance sheet unwind. It would cause volatility. There was also the big decision on the debt ceiling, and essentially what the US has ended up doing, it's not only postponed that discussion to December because of the effects of the hurricane, and that they would actually need funding for the post disaster relief, and that has allowed them to actually take shift the entire discussion into December. But they've also made another small announcement that they want to do away with the debt ceiling altogether. Now this has a very, very different effect, and I think it goes into my macro call, which has been for most of this year, that the US dollar essentially is in a bear market. So I think I've repeatedly said that over since the start of 2016. In late 2016, you did see a dollar rally back to make a slight marginal new high, and then from there on, I think since we hit 104, which was a 66% retracement of the last dollar bear market of the previous 7 years. In these 9 years, we retraced 66%, and that's why I said 104 would be the top. And from there we've been falling, and we fell to a low of 91 this week. And that last part of the sell-off initially didn't make sense till I heard this news that if they are really looking at doing away with the debt ceiling, it's in a sense that the government is going to continue, US government is going to continue to spend more and more money now without really having to debate the ceiling anymore. And its most direct implications are for the dollar, which means that you're going to be continue to expand your balance sheet, even though you may not be doing it through QE. It is going to be doing happen through the side of the government in terms of spending, and which is what I think since Trump was really elected, the whole talk was around him wanting to spend more. Now, of course, while spending limits may not go up as crazily as were initially thought out, but that said, as long as you're going to be spending more and more and there's no limit to it, it essentially signals a weaker dollar compared to the strong dollar that we were seeing for the last several years. In fact, part of that strong dollar rally was essentially based on a lot of hope that things would be very, very different. Where things would normalize, and interest rates would actually start going up. But those expectations completely changed because think of it from this angle that a lot of the money that was flowing out of the weakness in emerging markets and in China, the reinvestment was essentially ending up happening in US assets. And so currency moves are driven essentially by money flow, and the money flow from various other markets into the US assets, which is essentially US equities, US bonds, and US real estate, has started to reverse. In fact, you look at the Chinese yuan, I think nobody's talking about it, but the USD CNY, which even I thought till quite some time back would have at least one fifth wave rally left before it peaks, essentially ended up peaking after three waves itself, which means this entire run up in the USD CNY over the last several years was just a corrective move, and it's probably over. And such a sharp drop in the USD CNY means the Chinese yuan is actually getting stronger like crazy. So for all the talk of money leaving Chinese shores and going abroad, the strength of the currency essentially shows money moving back. And while one reasoning you can think of is that US bond market, which sold off around a year back, there were a lot of flows that were going out from the Chinese sales were one of the largest part of the sales in the US bond market a year back. Essentially, does it signal Chinese money moving out of US assets? So that's one sign, and it would also be true for maybe Europe, where things were showing a bit of a pickup, and then Europeans would reallocate assets out of US back to European assets themselves. So these shifts essentially are what would be behind the falling dollar. But now if you come up with a couple of more things, you say that US debt ceiling goes away, you say that the balance sheet unwind process starts, which actually puts more pressure on the US bond market, then it means even more money has to still move out of US bonds. And so the dollar bear market essentially becomes even more strengthened. So the reasons for the dollar bear market as they slowly come out would lead to recognition of the idea that yes, the dollar is in a bear market for a lot of people who've been still hanging on to the idea that the dollar bull market will continuously go on for much longer. and they are not yet taken the contrarian stance. But I am increasingly now even hearing their concerns on the dollar side, and I think slowly as these events play out, people will recognize that the dollar is in a bear market, and typical bear markets last for up to 7 years. So it's not something that's just 6 to 8 months old. You might get a rally from its oversold condition because it is getting oversold. It was so last week. I was still looking for a bounce, then the lows broke. But once again, the daily sentiment index is at an extreme, and you can really get a bounce back in the dollar that can lead to a rally for a couple of weeks before the next leg down really starts. So you can look at that kind of a situation, which can cause a correction in the commodities, maybe in gold. But eventually the long term view would remain that the dollar is in a bear market, and you'd essentially get further selling there again. So, what is the net effect of all these concerns for the Indian market itself? I mean, if you're going to see selling in dollar-based assets, whether it's U.S. equities, bonds, and real estate, then it does not usually come without a negative effect for most global equity markets and bond markets. So, I think while people might look at the falling dollar to correlate with what happened post 2003, the impact could actually be very, very different. Now, this is not the first time I've said this, and so far you haven't seen it happen, which is why you can still debate the other direction. What you have seen so far happen is the falling dollar has essentially caused commodity prices to go up, which is again something that a lot of analysts were underappreciating, because most of them could not understand why metal prices should actually go up, because they could not see the demand. They probably thought there was an oversupply, but simply demand and supply analysis doesn't work for this segment. Monetary policy and moves in the dollar essentially play also a meaningful role. And we also, in the study of commodity markets, as I've been researching more and more global macro cycles, essentially what tends to happen is that whenever you get a negative commodity cycle, a lot of producers actually change the way they do production. They actually stop doing deep drilling and other forms of activity that actually makes their mines less productive. So essentially it affects future productivity of those mines, and when demand picks up, then supply has its own lag before it actually can come back. So those things, unless you really study the depth of these markets, you don't really understand why prices are really rising. So you're starting to see this rise. It may not have spread to crude yet. Crude would tend to have a lag, because crude prices, in fact, crude's own peak production cycle goes all the way into 2018-19, so it might actually lag the rest of the commodities. Gold and silver would see peak production probably this year, and then drop from there. And so these are different cycles of working behind the scenes apart from what price activity has been indicating. So coming back to the idea that if you're actually seeing rising prices, it can at some point of time show up in inflation. If prices rise slowly, probably not. And then of course commodity price inflation is not the only factor that drives maybe things like consumer price inflation, but it would create a cost effect, at least in terms of the cost of production for various companies going up, and so cost push inflation to that extent actually happens. So it does not mean that you end up getting hyperinflation, but higher inflation levels will then provide a scenario for moving towards high interest rates. Then you have the US spending and debt ceiling levels, which would allow for higher interest rates, and then you have the Fed balance sheet unwind, which is also indicating absolutely the same thing. So I think one thing that it all indicates is higher interest rates. And that trend is not new, because 2016, I think we started seeing the first leg of the bear market in bonds. And the only reason it did not end up having a negative effect on the Indian bond market was essentially the idea that we ended up doing demonetization, which moved a lot of liquidity into the banking sector. And the way I look at the role of demonetization in terms of its impact on the economy is not what most people talk about, that it was actually something that brought black money into white money, and that debate has actually become more active after the recent data of how much money was really deposited, and also people end up discussing in terms of it would do away with terrorist activities, and then yes, that could be a temporary impact, but eventually people who want to do certain type of activities find their own way. So what is the most direct impact of demonetization? It was essentially moving a lot of liquidity into banks and then into the Indian bond market. So if you hadn't really got all that money flushing into the bond market, it would have been really difficult to bring down interest rates, because the fight till a year back was that the cost of funds for most of these banks were high, and therefore they were not really able to bring down interest rates. And the corporate sector, which has been so high on debt and so high on NPAs, and unwilling to really declare NPAs, or really start the process of bailing out or writing off these or rather filing bankruptcies for many of these businesses, they were essentially putting pressure on the government to bring down interest rates and make many of these businesses feasible from an interest cost point of view, and that would actually allow a better survival for these companies which are high on debt. And so I think demonetization was essentially a step that allowed the government to move this money into the bond market in two steps and bring down interest rates to a level that was more feasible. And since then, the pressure has been to further bring down rates, something that has still not happened. And my sense is that if the US bond market is going to start a third wave, which I've been expecting for several months, still no sign of it having started. But essentially, the US bond market has only retraced not even 38% of the fall that it saw last year. So people will not note that, but when you look at interest rates, they went from say 1.5% to 2.5, and you're languishing at 2.2. You're still at the upper end of the ranges, waiting for the next leg whenever it starts, because bond markets are much more slower moving than equities and other segments, so they take their own time. But my sense is at that point of time, what are we going to do? So how are we going to further lower interest rates in India? One way you would say is, well, a lot of money would come in to the Indian bond market from abroad. Well, that's essentially what has happened. FIs have been selling into Indian equities for the last 3 to 4 months, and even their year-to-date inflows have been 75% into the Indian bond market. And in August, a recent report showed that the limits that RBI had really allowed for money to really flow into Indian both government and corporate debt. I think government debt has been hit. The limit has been hit couple of times, and then raised and then again hit. The corporate bond market limits were also hit. So essentially, all the dollar inflow which was keeping the rupee strong into sometime in August, we reached those limits for the Indian bond market, and therefore there is unless those limits are really raised by RBI, we are not really going to see further inflows there, and that would become a pressure point for the currency and for the Indian bond market. So bond yields have essentially stopped falling. We've seen initial move up in bond yields in India and in various Asian markets. So you note that every trend that we note in India is essentially global macro trends, because after globalization and as money and liquidity flows around the world, whether it's investment in a particular sector, if you find banking sector is doing well, it's doing well around the world for that time period. If you find small caps are doing well, they're doing well around the world. If bond yields go up, they go up around the world. So this is what typically happens unless there is some local measure to change that scenario. So we've seen bond yields tick up everywhere in Asia, and then after that they've pulled back a bit, which is what we've seen over the last couple of weeks. And there is room for the next leg to start, and I thought that, and not just me, I think everyone would think that the balance sheet unwind announcement by the US Fed would be the trigger for the next leg. Now they've clearly said that they want to start that process probably by this year end, uh, uh, and if not, and if they even if they don't, they'll probably start it by the first quarter of 2018. So it's probably an eventuality. But on the other hand, they're also talking about doing away with the debt ceiling, which is essentially shifting of spending from the Fed side and banking side to the government side. And that's another big trend which I heard about as I was listening to all these conferences, is that one, of course, you're going to have the unwind cause volatility over the next quarter. But as we go into the next year, governments around the world are going to be spending more money, something that we've discussed and heard about, that and especially in the case of India, I think for the last two budgets, I was saying the same thing, that we need to actually start spending more money, and that's the only way that you can get growth back, because based on the structure of debt, it's really not happening, and government will have to take onus of some kind of a stimulus through spending. And now that's going to be the case around the world. As central banks pull back on their QE, the onus will shift to stimulus coming from the government side. And another reason why a lot of analysts are positive actually for earnings into 2018, if not in the first quarter, maybe later on, and that they expect that the downside would be limited, essentially, I think, based on this factor, that they think that governments around the world will now start spending more money and stimulate the economies. I think that's essentially the hope dynamic driving this thought process. And when I look at it, I see a falling dollar, and if there's more spending, then even more a falling dollar and higher commodity prices leading to more inflation. And if the government is going to spend more money, even more inflation. And if the RBI is going to be buying all these dollars like they have over the last couple of months, then that can also be inflationary. But of course, inflows would, at least for the time being, slow down unless limits for fresh investment are raised, or unless FIs start buying equities now instead of bonds, then that would lead to fresh inflows. So those are the multiple dynamics in place. So one thing that comes out clearly is higher inflation and higher interest rates. Out of all these effects, higher inflation can be good for markets at some points, and it can be negative at other points, depending on whether it leads to cost inflation or whether you're able to pass on higher prices. But will the government in India actually end up spending much more money into the next few quarters? If you look at the amount of spending that they've already done into the June quarter, they've really exhausted a large part of their fiscal budget plan for this year. And based on that, people are projecting that they will end up overspending in this year. But my only question is, when you've put in place the FRBM Act, and you want to actually manage budgets tightly, and also that one of the criticisms that the current government has won against from the previous governments is that there was a lot of inflation in the previous regime, and would you really take an inflationary stance when you're looking at economic decision making? And so that's the tricky aspect. I don't know the answer. I've said this for years, that unless you really inflate the Indian economy, we are in an economic winter and you are going to unwind. I think that's where we are. We are looking at all these debts being written off, and now that you've come to the acceptance stage, you're entering the final stage, which is the execution stage, where you actually get assets being unwind. These banks need to be funded. A lot of their balance sheets would get completely wiped out, and if they don't get fresh funding, either these banks get sold to somebody else at pennies on the dollar, or they end up being merged with some other bank. We don't know. One of these many things can happen in the coming months. All of a sudden, will these corporates get bailed out? Will they, or will they have to go under closure? So a lot of assets would come into sale, and these are a lot of negative effects that can take place. And of course, those in power would like to really avoid these negative effects, because it would create uncertainty and not a very good environment in terms of as we get closer and closer to the next election. So you want things to remain stable. So we would try to aim for stability, but given a lot of these angles, it's not going to be easy. So I think increasing volatility is a given. Like I said in the beginning, we are underappreciating the downside effects of what a lot of this means. We might tend to overthink that yes, government can spend a lot more money, but if it has to stick to the FRBN limits, it might only be able to keep things stable, but not really inflate out of control, at least not to the point where inflation becomes an issue. And if inflation is a global theme, then we would be more firefighting rather than doing our own inflationary measures. And you'd also have to get consensus on this. So far, whatever weakness we've been seeing in the underlying economy, because of steps that we've taken, like GST demonetization and the positive sides to those effects, it's easy to not only blame them but to say that okay, it's temporary and these are good for us, so let's pass it, let it pass by. But if they were not there, you'd actually see the real weakness of the economy. Now, you will justify the weakness that you're seeing right now because of the measures that you have done, which have long-term good. And so you would have to come up with similar justification for inflation and for being able to spend more money beyond the budget limits that you really had this far. And my sense is that would only happen when you actually enter a crisis. So far, right now, we are not in crisis mode as far as markets are concerned. You're only in an overbought and an overvalued zone. And when you move from that towards some kind of crisis mode, then that would provide reason enough for the governments to actually move and try to get consensus on government spending and inflation down the road. So I definitely think those are an eventuality. Only I don't think these measures don't come at the peak of a market. They always come at the lower end when markets are in panic, or when they are when the negative effects on the economy push you to the point where you have to take those measures, and everybody comes to a consensus that yes, this needs to be done irrespective of the negative effects that it may have in terms of maybe higher inflation or higher spending or a lower credit rating and so on. So we are entering that phase where we would therefore see all these negative effects play out. Like I said right at the beginning, you are seeing a distribution pattern in the broader market indices. You're seeing an intermarket divergence that sets us up for more downside than upside. And I think not just this month, but probably the next quarter or two would be interesting. Of course, a quarter or two are too short a time period. So, like I said, we underappreciate the negative effects. No period of consolidation or correction in India is less than a year. In fact, major bear markets, there's only been one that has been longer, which was 2000 to 2001, went on for 18 months. Otherwise, typically 12 months. And so expecting that all this would play out only within a quarter, I think within a quarter you'd start getting the events move in that direction in a strong way, and then their effects and actions would continue to have an effect for several quarters, and therefore you really need to keep a time horizon which is 12 months down the road. In terms of broader levels, I discuss all of those in the long short report, where things can go over a 12-month time horizon, what is the broad structure, and those calculations. But essentially, my sense is it's been that way, I think, for the last several months. So I don't deny that, whether it was at 9,700, 9,500. I'm not looking at the last 500 points up in the Nifty. I've been thinking more of what would happen when things roll over, because in my sense, this is not a runaway move as yet till you really complete the final stages of the economic winter.